That up? Running? Cool. Sorry about that, guys. Uh, I had to dial in a new coffee and it took me a bit too long. Oh, that's fantastic. Hello, Guevara. It's very difficult. It took me like an hour, and I was expecting it to take me like 15 minutes. It's a very touchy one. Did you trim your beard? A little bit. It was getting fluffy. Is it time to convert my 401k to bonds and money market, Garrick? What if the bonds and the money market are gonna crash too? Are we allowed to say the V word? Yes. Would you like to? Be the first. I was arguing with myself, and I think I'm wrong. Does getting assigned on a CSP force a locate for a share? Yeah, yes. Actually, well, technically the seller or well, yeah, I mean it could if you're assigned. The seller of the shares, which would be the buyer of your put, the long side of that, yeah, it could, but those shares could be just sold immediately. Remember that puts are secured with cash, not like equity collateral. So it probably doesn't create the same situation that you get with like the OCC collateralizing in the money calls. Can you talk more today about how an ETF fails and what happens when it does? I mean, it's not very different from, you know, an equity fail. It is an equity fail. There's a bit more nuance with the timeline for authorized participants, and not only that, but the reporting of the trade itself. So, you know, with like market makers, the reporting of the trade is instantaneous, and then they have like T+2 to fail, and then they have an additional 2 days to clear that. Um, with an AP, you have your T date, but then the T date can be extended to when the ETF managers report the trade, which should occur within 3 days, but it doesn't necessarily have to. Um, they have kind of like a lot of flexibility for when they decide to report the trade to the NSCC, depending on the authorized participant they're reporting on and their relationship with that authorized participant. Um, then you know they have an additional 2 days, same like the market maker, right, to clear those fails, which gives you T+5, which is technically the total amount of time an AP has. We use T6 because the settlement period actually ends on the 6th trading day, and since they cash settle ETF fails like 100% of the time, um, we can use T6 to determine uh the final day, because that's the before market open on the final day is their last chance to cash settle. Um and then the rest of ETF failures are relatively the same. Like Reg T is the same. If it's marked long, they get an additional 35 calendar days. And then this part's the other weird part, is there's an additional 2 to 3 day trading period at the end for ACH settlement. So since they're paying with cash, they're doing a transfer. Uh, and they have up to 3 days, depending on the ETF. Vanguard and BlackRock tend to be 2. State Street tends to be 3, but it varies ETF to ETF. So I hope that helps you, Odorous Colon, a little bit. Why they fail, they shouldn't. They simply fail because a locate is not performed and a failure to deliver occurs. So somebody has naked shorted and chosen to leave that naked short open through the trade being reported. Hey Girk, how you doing, bud? Doing alright, Eddie. How are you, man? Kind of by Google. I don't dislike the price. I now have 2/5 of my planned Google position, which I picked up the second fifth on Friday when it fell below $85. Or Thursday. I think it was Friday when it fell below 85. Anyway, so yeah. I think I might get cheaper prices in the next 2 quarters. So I haven't bought the other 3,000 shares I intend to buy yet. I think my next target range is going to be somewhere around 80 or 75. Only joking. Volmageddon. Can they do a Wyckoff plus volatility combo? I mean, here's the problem with Wyckoff on GME is I think that the phases are very, very rapid, right? So I would argue that every real big OPEX we've had has been distributive, right? And then the period between OPEXs is accumulative. Um, so these are all like Wyckoff phases, and if you really think about like the psychology behind Wyckoff, it's true, right? But instead of longs going long GME on the low end, which some do, don't get me wrong, most of the volume is created by people going synthetic short, which is the same as future long. So, obviously, Wyckoff, when he wrote his theories, was not prepared for the market plumbing that we have nowadays. He was not, writing those theories around the idea of these supplemental liquidity pools. Um, but, a synthetic short is, in fact, a near term future long position, right? Because the obligations created in order to synthetic short have to be satisfied within a fairly narrow time frame. Not really inverse Wyckoff, just something that Wyckoff, never had to deal with. It's still applicable in a way. Wyckoff has a lot of limitations. I know people really like it. That's because it kind of makes sense and it has a market psychology aspect to it. But it's useless unless you understand volume trends and deviations from volume trends. Um, So, your average investor is not going to be able to use Wyckoff very effectively. And then you really need to understand the underlying and positioning in the underlying to get a very good read on price action that is outside of its standard range. Hey Greg, should I sell CCs on GME at the top, say Monday or Tuesday for 11.18? Do you think a drop in price and a buyback before 11.18 to position for Opex? As long as you're aware that you may need to buy back before 11.18. So, really hang on tight to whatever credit you receive. But yeah, I mean, tomorrow's the biggest pile of ETF FTDs. The next day's minimal, but it could be stabilizing. Days after that, they should have more liquidity to short. No, I don't think CSPs will have the same impact they're hoping for. Interestingly enough, covered calls that move into the money are far more likely to create that situation, um, with dealers scrambling for shares, which I think we saw in May. In May, a lot of people sold covered calls into the OPEX run, and the borrow rate rocketed, like went above like 100%, I think, at one point. Because the OCC, immediately upon the contract going in the money, the OCC requires the broker dealer collateralize the options, which means they have to locate 100 shares. That was an awesome explanation. I was asking about an ETF failing as in becoming insolvent, and why you wouldn't want to trade SPY for a crash, the consequences for long holders of the ETF. Um, you don't want to. I think, and this is like I said before, it's a bit tinfoily, but I think that if there really is a massive bad credit risk in the market and primes are going to de-risk, ETFs are going to be the hardest hit by that. And funds may fail to appropriately accumulate NAV during the given trading period and ultimately implode. I think ETFs currently are a contagion in any kind of financial crisis. Um, and so, yeah, I mean, the risk maybe not as bad as I think it is, but I think it's pretty bad. So I think of the instruments that you could use, they are the least safe because they are most exposed to synthetic liquidity creation. Far out of the money Bobby calls, same like Powerball tickets, maybe worse odds. Are we looking to go up until CPI and then dump after it for SPX? For the dump after it for the SPX? The SPX. Okay, that's a confusing. We might go up until CPI. Yes, we get a drop before OPEX, which is the SLD period. It happens once a month. How are you feeling about SPY SPX? Pretty good. I liked the move into close a lot on Friday. pretty bullish momentum, a lot of call side build up, starting to see some leverage call positions come in. We don't have updated OI till tomorrow, but ES closed at 37.80, which I think puts us in a really good position to push for the kind of gamma flip point on SPX, which is at 38.25 ish. It's a floating target, so it might be different Monday, but I think it's like 38.25 or 38.37 right now. Any chances my 155 November 18s are going to print or not enough time left? I bought the day before the JPOW rug pull. Yeah, that's rough. I assume you mean Apple. You didn't say what stock. It's possible. Apple is on its bottom trend right now. If it's going to reverse, which it did a little bit Friday, it would reverse from this point. 155's rough, but there's a lot of call interest to the upside, so it's very possible. And don't forget that Apple also has um, net negative gamma. So if it does start moving up, the market maker will be buying into rising prices, which means they will move up a little faster. You could always roll out or average down. Averaging down is probably kind of risky. I would say you really only have a few more days to realize that price action before theta just starts to destroy the contract, though. So be aware of that. Do you normally build a position 20% at a time? Just depends on how I feel about the price point. Sometimes I'll buy 100% of my position at once. Like BTU's a really good example. So I had BTU much earlier in the year and I sold it. Same thing with X. Right, and then let's go back out to the 1 day. So that BTU much earlier this year, like back here. I think it was like in the $17 range, somewhere around there. I sold out of my position near the top. Most of my position, I think I sold out the rest of it on the second test of 30. But I was much more aggressive with my buy-ins coming back into it. So I think about 30% or 40% of my capital on the initial buy-in, and then this last buy-in when it just slipped sub 20, I bought the other 60%. So yeah, I didn't think it was going to stay sub 20 for very long, and it ultimately didn't. So sometimes you want to be a little more aggressive. Sometimes you have a little while for whatever situation you're hoping will deteriorate the price of the stock to play out. Like with Google, I feel like this is the first of a few quarters of relatively shitty earnings, right? And so I think I'll have plenty of time to get lower prices, and I want to deploy less capital up front, and I'd rather deploy more capital at lower prices, right? I want to ask about GME 31st October run up. Linux called it on the 20th. What do you think could have been the reason? How can we predict future spikes outside of OPEX? And possibly, can it affect November OPEX? It does have some effect on November OPEX. I mean, Linuxus is just counting them. Everything's cyclical on GMA. So, as far as I'm aware, his approach is to use technical analysis and just count the number of days between events. He frequently misses on ETF FTDs because he refuses to acknowledge their existence. But some of the more obscure ones hit. The liquidity dumps on GME have historical precedents, but they are offset sometimes. So there's like a day or two miss on them, where they can fall a little earlier or later in the cycle depending on kind of the first day of that month and where that expiration falls. But there is precedence for those runs. They've happened before. November 3rd, January 6th, March, I think it was like March 11th. So, they're part of the cycle. They're just not something we ever paid very much attention to, because we didn't have as much information about liquidity back then. But now in hindsight, if we go back and we look at them, you can see that, like, here's an example of one, right here. There's examples of them. Sometimes they don't lead to a lot of price action, right? Sometimes they're very muted. Sometimes they're not so muted, right? Like here in January. But with liquidity data, we can kind of analyze where they get liquidity, and so where liquidity returns to the system, and those dates are one of those events. Except they don't generally occur very strongly when they don't need liquidity, right? So like here in March, this is after ETF FTDs, so they're already fairly liquid at this point. And so they get a little liquidity, but not much, right? And in May, they didn't have a lot of ETF FTDs to clear out, and so they needed more liquidity in order to get sufficient liquidity for Opex, or to carry out through Opex. Linux called for November 1st, so no, he was wrong. Yeah, I mean, he was, but like I said, it can be off a day either way. The problem with them is they don't always perform very well. Sometimes it's kind of just like on March 8th, where our high is 27, but our close is back at open, right? Because the market maker gets the spot price right back where they want it very quickly. You could even look at June. I believe it was the final day in June, Friday the 24th. This was also one. You can maybe see it on Henkin Ashi candles better, or at least it shows up green on those. But this day was one. But see how they're generally like dojis. They're very flat, because the high and the low for the day are usually relatively similar. And so obviously they're not ideal to try to play. This one was pretty big, which is indicative that it has some potential to be a leading indicator of the size of the coming Opex. But that would also mean that the coming Opex is probably significantly smaller than like November or March were, right? Still thinking crash Q2 3 2023. Q1 2, I would say. We'll probably start to see deflation beginning into Q3. Although I suppose it could be as late as Q3, but at least through Q2 reporting, right? Tony T, welcome to Dillionaire, man. Thank you so much. Hit me up on the Discord. I'll get you added to the country club after the stream, my man. What are your thoughts on playing futures if there's an actual serious move down? Safer? I have some. I have some March 2023 E-minis already. You comment again why you're not a huge fan of playing ETF FTDs on GM anymore. I'm not a huge fan of playing these ETF FTDs. In August, we had, a few days, well, really 3 days, 1, 2, and 3, with very elevated ETF FTDs. I think all 3 days were over 1 million FTDs. One of the days I believe was 2 million FTDs, right? Whereas for this cycle, only one of our days is above 1 million. It's at like 1.67, I think. And that's tomorrow. That's the only day of like significance though in this ETF FTD period. All the rest are like sub 500,000 for the most part. Well, let's say they're all 4 or 5 or 600,000, which isn't a lot. If we go down to like the more like the tighter time scale, Friday was fairly low for ETF FTDs, but Thursday was decent, and so we had like all the signs of ETF FTDs on Thursday. We had a higher volume pre-market. We had some fairly significant arbitrage and a large liquidity grab, and then we had to run it open right until the FTDs were cleared out, and then shorted into the rest of the day, right? One other note about like Friday, Monday, is that we were already very close to the flip point, which intensifies the effect of this buying, right? So we were like right at the gamma flip point, moving into Monday morning. I think we actually crossed in pre-market, and then also we're not sure yet, but I have to go back and do some um, kind of like accounting of XRT. But it may be that these liquidity dumps we're seeing are in fact the clearing of XRT from the previous Opex cycle because XRT is on reg show. So XRT is on reg show, which means there's like a 13-day delay on its clearing. And this might be why we didn't see these liquidity dumps so much last year and we see them much more now, right? Because now they put XRT on reg show through at some point in every cycle. And so that might be the offsetting of it might just be ETF FTDs, but just for XRT, right? Because that's the big advantage of getting XRT on reg show is that it takes XRT FTDs and the rest of the ETF FTDs. It's one of the big advantages. The others, it prevents locates to a degree, and it splits them up, right? So instead of having them all piled into one day, instead, you have XRT clearing on this other cycle, while ETF FTDs are clearing here, or the rest of the ETF FTDs are clearing, at the same time. And so what that allows them to do is diffuse the covering in order to reduce the effect of it. What do you think about IWM 140 puts for 1130? Too soon? Not enough time and way too far out of the money. How high do you think this SPX run up could go? Hard to say. It depends on, how much pressure it puts on long volatility positions. It could go, I think, pretty high if it does. I mean, 7, 8, maybe 10%. If you consider the fact that like if you look at Volmageddon, you look at other risk-off scenarios before it crashes, it tends to be a fairly rapid price improvement on the indices of like 700 to 800 basis points. But historically, margin in the market at those times was much lower than it is now. So this could be as much as like 1400 to 1600 basis points, given the fact that margin in the market is about like 2 standard deviations higher than it was during the Volmageddon period, right? more so the effect will be realized on stocks that are like mid cap or low float, where more margin is deployed and more shorts exist, right? So it's probably likely that like Russell and Nasdaq would run far harder than S&P would. When do you think we will see the Fed Powell switch to be less hawkish and more dovish? Consistent decline in core inflation. Probably I would say three data sets in a row that show a pullback in core inflation, and we'll start to see them. I think we'll start to see them ease after one or two. I think we'll see them pivot after like three data sets, maybe four. You're still bullish on Upstart? Have you softened your stance since they were taken off reg show? Not at all, actually. Upstart's cycle isn't in line with GME's. Their ETF FTDs occurred a little sooner because they're not in a lot of ETFs. First of all, they're only in a few. And the ETF that they appeared to source liquidity from the most, which is bots, was reg showed around the same time they were, and so their ETF FTDs were a little bit offset. That most of their big ETF FTDs occurred earlier in this week. Now we're seeing the effects of market maker FTDs, which are very high still on Upstart, but we're seeing those be cleared out. Um, there was a lot of synthetic liquidity generated on Upstart for a very long period of time. And I think there's a very good chance that, we see some pretty significant price action on it out of this Opex, or just before this Opex. I would say sooner as possible, given the offset in time from GME's cycle. Upstart ran really hard in like February, but not so much in March, which was interesting. They are a little more synced up now, so we'll see. But most of my positioning is planning on capturing some sort of movement from Opex. Now, if Opex happens and Upstart ends up back on reg show after Opex, that's a very, very good signal for the future. But yeah, most of my current play is targeting Opex. So not at all. You know, it was one of the first things we discussed on Upstart was, at some point they're going to try to get it off reg show in order to facilitate the clearing of locates that they would not be able to perform on reg show. That doesn't mean that it's failing any less, right? They just got it to fail less for 5 days, which takes quite a bit of effort and capital, and was probably a little more possible after they cleared out the ETF FTDs, right? And that's when we saw it go off reg show, because they get a little bit of liquidity after they do that. Not a lot, but a little. Selling CCs tomorrow for November 18th for GME. Still the best bet based on historical trends, right? Yes, but be prepared to buy them back early based on historical trends. So you may need to buy them back as early as like the first day of SLD. We calculate IV30 ourselves. And the DPI data you can get from FINRA. It's called PMI data. I think FINRA releases it every day at 5 p.m. If I'm not mistaken. It might be 6 p.m. I think it's like 5 p.m. Chicago time. Leading exposure for November Opex. DCing December calls. Too much theta. Just enough to cover the settlement period. After the settlement period, those contracts get a little bit worse. But if the price of the stock is increasing, then they're fine. If the bond market doesn't start cooling, does this accelerate your timeline of a potential crash? You mean if some sort of liquidity provision isn't introduced into the bond market, specifically the treasuries market? Yeah, I mean liquidity is only going to get worse. They just raised the federal funds rate another 75 points, right? So that's only going to further accelerate like near-term yields, which is going to make vintage products even more illiquid, right? So raise as long as they keep raising rates, the liquidity problem there is only going to get worse, not better. And quite a lot worse every time they bump it 75 points, right? So the most recent Fed rate increase is likely to only accelerate what we're seeing there. Sorry, I'm trying to get to. Does the prospect of a Volmageddon type event make you wary of selling CCs on GME or other heavily shorted stocks if they do end up ripping as a result of margin calls? To an extent, yeah. I mean, I'm probably not gonna like full port into covered calls at any point. And then, for GME, I'm selling. Hopefully, I'll be selling covered calls on like a local high, so I don't have to worry so much about it crossing that point in the next few weeks. I mean, obviously, I'll keep the premium on hand if I need to buy them back. Try to prepare yourselves to buy them back because the market is really volatile right now. With internalization and the put walls on GME, though, they'll fight back against any broad market pressure, and so, obviously you'll have some warning signals, uh, in order to buy them back. Thoughts on CPI data? Bullish, bearish, hot sideways action. We'll see. What core core increased last time around. I think, but less. So the rate of increase had dropped off. Obviously, with just 2 data points, it's really hard to say. But I would say that there was still a continuing trend in core inflation increases, right? We went from July and June's flat like 5.9, was it? Up to like what was it? 6.3 was the big surge up. So we moved up 0.5. They moved up 0.3 on the last one. So I would say either we see a small drop. I think a small drop is more likely this time. Like we could see a pullback, or like 6.6 was the peak, or we'll see a slight rise, but maybe not as much as the previous. So I would say 0.2 up to 0.1 down for core. So between 6.5 and 6.8. Anything beyond that would probably be anything to the upside beyond that would be very bearish. Obviously, a harder pullback would be bullish. Futures is definitely a margin account thing, unless you have a shitload of cash. They're very expensive. I have a large holding of VTI, essentially the SPY. Do you recommend long calls on the VIX to hedge for the crash? Is there some resource that I should look at for hedging? I don't know if there's like an inverse VTI fund, but maybe something like SPXS or trying to think like a broader, maybe like a broader. Is there an inverse VTI? Let me see. There might be. Maybe like RWM, like inverse Russell 2000, because it has broader exposure than like Dow. Well, you could do inverse NASDAQ too. NASDAQ's a little broader. The reason since your position's in VTI, you probably don't want the hedge to be on S&P. You're probably better off being short the Russell or NASDAQ, like a broader index, than the S&P 500, because VTI has a lot of like mid, micro, and small cap exposure. Not by weight, but cumulatively, it's quite a lot. So, um, yeah, I probably wouldn't use VIX directly to hedge that. Um, you could also just buy protective puts with a fairly sufficient amount of theta, right? And then you can collateralize, or like well, you can capitalize on the protective puts on the downside. Sorry, just I know I'm really far behind on chat. I'm just trying to get to everyone's questions because I know a lot people have a lot of them right now. Okay. Wheeling a stock like Fubo, is there really any issue with getting assigned? Not really. I mean, it's pretty cheap. Um, Seems like being aggressive and playing both CSP and CC at the same time, not a bad plan. Yeah, I sell a lot of short strangles on Fubo. I have been since I entered the position. It's been pretty profitable. I mean, CCs aren't as good as puts, but the money's been solid if they were entered at a good time. How do you feel about Upstart? Have they done all the shorting they can, or still more to come? Um, with earnings on the horizon, I would say that there's definitely a chance they continue to attempt to short Upstart more. Like I said, you know, $20 CSPs going into earnings are kind of risky. I'd want to be a little further out of the money. Um, Interestingly, you know, their earnings is kind of usually where we see GME earnings before a big OPEX. So I would expect like a large short in order to get as much liquidity as they can from a bad earnings if one is to occur. Ever really the cornerstone of my port. Cost basis makes the divvy 10%. I'm up 230% or something on the shares, but I'm unsure about holding through a crash. I mean, like I said, protective puts, right? For every 130 shares you have, one put. You can go, you know, slightly out of the money since you're up so much, right? So you know, you could probably go like 0.3 or 0.2 delta. Like obviously you don't want them at your cost basis because it's so much lower, but yeah, protective like put leaps or like And since it's such a large part of your port, like 6 month, 1 year, 2 year, something like that, just like a standard protective put hedge. Except, obviously, if the price of ZOM doesn't fall in a crash to your cost basis, all you've done is just capitalize on the drop. I think their good earnings and solid dividends will continue across most of the oil industry, although governments are pushing back against that. If you aren't in Upstart though, right now, I would wait till after earnings because I think there'll be an opportunity there. What's your take on oil stocks? I like them for the most part. I mean, I'm in Oxy. I have a position in BP. I might be getting another position in oil kind of soon, um, just because some. Well, I'll cover it in Pickles picks. I mean, Monday has the highest chance of running really hard, FN. So GME CCs would most likely be best on Monday. Then like Tuesday might stabilize price action, but ETF FTDs for Tuesday are a lot lower. Hey dude, thanks for these weekend streams. Any thoughts on AR based on the charts? And Tarot? Let's take a look. Not terrible. I like it. It's been a little while since I played it. I think the last time I played it was like back here. You have pretty tight risk at like 3650. There's a upside gap at 39, but 38 and like 40. So I've had to, I would say that would be like my risk mid in PT if I were to be in on Ontario, Elliot. Not a huge move, but okay, I guess. It's like 10%, maybe a little more. After the SPY August peak, I know IV on options is usually fairly low on this, so it might not be terrible. After the SPY August peak, I thought we would never see like 430 again, lol. I currently have some SPX leap puts, but better to prepare some call hedges next week, I guess. I mean, you really have two choices right now. You can try to play the melt up, which is really risky, or you could just slow position into long dated puts, which I would say is a little less risky as long as you're not too far out of the money. Especially around the like 35, 34, 3600 ranges. Those are all probably not the worst bet. And then you can avoid the risk of playing the upside, which is extremely risky, but the upside might also be extremely profitable, right? And when I say a lot of theta, I mean like minimum 90 days, probably more. I'm considering moving a significant portion of my port into a wheeling strategy. What are your overall impressions of wheeling? Targeting stocks 60 to 100 IV and selling 2 week options for a 2% return, 50% annual possible. I mean, you can beat that if you get good at it. But yeah, it's more than possible. There is a lot of risk in trying to wheel in a bear market that's this frothy. Um, I would say I would wait for a market bottom to begin really digging into that strategy, and I would keep a little or most of my risk off the table right now. Like I would keep my money off the table right now if I was purely wheeling. Right, because your chance of assignment on CSPs in a bear market trend is much, much higher, right? Especially if you're targeting stocks that have high volatility. So the things you want to do, yes, but the strategy in this environment, not great. Each federal fund rate increase seem like options market on a split stock where old options become way less desirable. Kind of, yes. Similar. Thoughts on selling Upstart CC this week and buying further out of the money calls for December for a net credit with a premium. I'm gonna sell some pretty aggressive covered calls into earnings. Even if earnings beats, I already have way more shares than I initially wanted. So I'm okay with assignment on about half of the shares I have currently. So I'll probably be pretty aggressive with my CC selling, and then if they drop the price hard, at least I capture some of the premiums and get my cost basis down. Right. Good morning. Tuned in late, but listen to the BTU part. What do you think of the overall cup and handle chart? Could be nearing a breakout with the energy sector. I agree. I think energy and commodities are going to move towards heating up, and BTU's both, right? So they provide commodities for the energy sector, so they might heat up a little faster. I think BTU over the next 6 months to a year is going to be very, very profitable. I have pretty obscene price targets for it, and their most recent earnings only furthers my bullishness on them. And what's been a pretty good position for most of this year. I've already made a pretty decent amount of money there, but yeah, it keeps doing its thing. You recommend 1 to 100 shares of what? What are you talking about? CI is one of my long-term holdings. I want to sell 125 400 cc's. Ask is currently 40. Delta is 0.44. Trying to use this as a hedge in case of a crash. Current price is 321. Any thoughts? Uh, Generally, if you're trying to hedge a crash with covered calls, you'd be selling in the money CCs. Let me take a look at this. So yeah, if you were trying to hedge a crash, right, or return to like COVID lows, something like that, you'd be selling like in the money covered calls, not out of the money covered calls. That's kind of, I mean, don't get me wrong, yeah, $400 is probably could be a few years out um here, but I don't think healthcare is gonna underperform that hard. If you're okay with being assigned on your holdings at 400, then that makes a little more sense. But generally speaking, if you're trying to use CC to hedge against what you assume will be a near-term rapid decline in price, you would you would sell them in the money, not out, right? So you're taking a loan against the current value, and then if the price drops below the current value, you would simply um, buy your cover calls back. So like I don't own any of this, but if I did, I'd probably be if and I expected a crash, I'd probably be targeting like, you know, that range, for instance, right? Selling $50 in the money, um, roughly. And then if it does crash and we see, a fall back to like the 240 level, then I would simply buy these back. Although with their dividend coming up, I would wait on selling covered calls because they can get exercised if they're in the money at that during that period. How big is your Upstart position now? I have like 1,200 calls, various strikes, all of them for January now, I believe. I'll probably move that up to like 1,500 after earnings as I get closer to the money calls. And then I just got assigned. Actually, I haven't looked at what I got assigned on. Let me take a peek. I think I got assigned on everything, but I'll double check. Well, I haven't been assigned on the 1950s yet, so it looks like I've picked up another 7,500 shares. Definitely, yeah, definitely assigned on the 20s and the 21s, but yeah, the 1950s I don't think I got assigned on, which is kind of cool. That could still change by tomorrow morning, but it looks like I'm not going to be assigned on them. So yeah, exposure to about however much delta in calls. I don't know. And then that's gonna be 15,000 shares. Can you tell us more about the expensive data you pay for? I mean, somewhat I can. How do you use it? We use it for calculating, um, well, several things to do with the options chain. Yes, we use it for the Greeks, but we use it for a lot of other stuff too. Um, Data for the poors. I mean, data that's publicly accessible is generally fairly limited. So it's a little more complete. Um, it's a little less delayed. It is necessary. Um, we're trying to do it with the bare minimum of cost, but even then, it's still quite expensive. And it's all through APIs, so you have to download it and format it and calculate it. Or do you see the short pressure easing up on Fubo? It looks like most of the put position closes out after the 18th. Some of it's starting to bleed off a little bit, but not much. It's still an Opex stock, so periods of price improvement are probably still going to follow the same schedule as the rest of the Opex stocks. What are your thoughts on Carvana? Do you think this push down was an attempt to drive prices lower before shorts start to cover? It's possible. I also just think the company is kind of shitty. I think their fee schedule and commissions and the business model isn't very useful. Most people would still rather sell a used car on Craigslist and get paid cash and save the money on taxes. then people who have enough money would rather just go into a dealership and trade their car in because they don't give a shit about the loss. So, because they'll write it off, right? So, they're targeting kind of a really slim sector of people that, not only want the sale of their vehicle fully disclosed to the DMV, but are too lazy to sell it on Craigslist. So, I mean, I don't love Carvana. If used car prices drop, they might see another rally, though. Is China going to gap down tomorrow due to COVID restrictions being confirmed, staying strict? It could. I mean, I don't know. China still has their banks buying their equities, so is anybody going to be ballsy enough to go short? Right? I mean, they already they were pretty clear in their economic summit that they weren't budging on the COVID restrictions. So I don't think them re-emphasizing that they're not is going to have that much of an effect. Hedge crash, it's one put per like 130 shares, depending on how in the money you are. The more in the money you are, the more like the fewer puts you could buy. It also gives you more flexibility with the delta of the puts you buy. What equities are going to be less or not affected at all by the potential crash, and which ones are going to be affected the most? I mean, all equities will be affected by a potential crash. Ones that are overvalued will be affected the most because they generally have the highest amount of ownership. So things like Tesla, Amazon, things that are trading at, absurd PEs will get sold off the hardest, right? There's some things that are less exposed to a crash, but they'll still drop in price or value. Um, things like Kroger or Kraft Heinz or Tootsie Roll, like those they're affected by crashes, but not as much because, well, one, not as many people own them. Two, they're not very overvalued. So and value stocks will likely recover faster from the crash, but smaller value will, if you're looking for something that's going to weather the crash, there's no guarantees it's a crash, right? Job growth through the last reporting period was mostly in healthcare. I expect healthcare to be one of the industries that does fairly well, even if we get a recession. What equities are going to be less or not affected at all? Okay, I already answered that. Yeah, no problem. Buy Blockbuster. I keep thinking I should get out of my high cost basis GME shares before the end of the year to avoid being so underwater in a crash scenario. Better to take a hit for cash to reposition or dumb. Um, Maybe not necessarily dumb. Don't forget the tax implications though. If you were to sell this year, uh, the tax liability will be for this year. You might be able to reduce your cost basis drastically on a large run by selling deeper in the money covered calls. If you can sell, if we run to 40 and you can sell deep in the money covered calls kind of far dated in like the $20 or $25 range, that frees up a lot of your capital going into a crash, dramatically reduces your cost basis, And, you know, if you're assigned at 20, so be it. But if you're not, you know, then you've already reduced the cost basis of your shares on the other side. If somebody who's not yet in BTU, what might a good entry look like right now? I mean, they're not as attractive. Obviously, I was targeting a cheaper price. I would say sub 23 is really nice, but the current trend doesn't look like you're going to see that very soon. You know, if you go back, the last time, you know, commodities got kind of hot, BTU was trading, you know, in the like $30-40 range. Most of its volume, I think data for this only goes back to like 2017. I think they were private before that. Um, I don't expect a lot of pullback, but yeah, I mean, if you can get stocks below like 23.50, that's a really good deal. If the market surges, that'll cool commodities a little bit, so you might see another return to the $20 range, but I doubt it. Amazing how much money and work goes into the little numbers at the bottom of the screen. Far more work than money. Do you think extremely helpful in making our options decisions? Thanks to the entire team for all the hard work. No problem, Beth. I think a lot of people don't realize the value of those little numbers at the bottom of the screen. I'm thinking of getting November 25, December 2, and December 16 calls on Upstart after earnings for Opex. Do you think I should buy them further out? Well, I don't like the weekly contracts at all. I can tell you that much. They could lose a lot of value before the stock ever runs, especially November 25s with the reduced the theta drop off that'll occur with the holiday on those. Um, so the November 25s and December 2nd calls sound terrible. December 16s for OPEX are fine, you know, for a 3-day hold. I expect them to short it after earnings, most likely, but I have no idea what they'll actually do. Earnings could be, and maybe they get pressured. There's a lot of sellers and no buyers, right? Yes. Well, if there's a risk off, there will be a lot of sellers and no buyers. Right now, there's a lot of friction in the treasury market and liquidity is low, but there are still buyers and there's still, you know, buyers and sellers are not in the worst position. But yes, Japan could exacerbate that immensely. Uh, and even if the treasury market was liquid and Japan began to sell off treasuries to stabilize the yen, it would fuck up the treasury market. They have a lot of U.S. treasuries, um, but yeah, I mean, with each rate increase, there are fewer buyers, right? And when a risk off happens, it generates a lot of sellers because everyone needs margin at the same time, right? So it creates a run on the treasuries, which the treasuries couldn't sustain right now. Best way to protect against black swan event crashes, long dated VIX calls and SPX puts. Yeah, pretty much. Maybe don't sell high GME costs. Cost basis GME this year, an expectation of higher returns next year. Depending on amount up this year, expect those are likely long term shares. Yeah. What's a question? I mean, if we get a solid Opex run, because I'm not really sure we're gonna see a lot of potential out of like GME earnings, which should be sometime around December. I might wait till earnings, but at some point on GME, I'll probably sell some deeper in the money covered calls. If we get a big Opex and we get up into like the $35 range, I'm more than comfortable selling like $30 calls on GME, 30 or 20, even like $28 calls on GME. If we go higher, obviously, I'm still comfortable selling those. So, but my that would, I mean, if we get a real OPEX, my cost basis on GME will be negative, so it's kind of a different story for me. $35 range doesn't scream big OPEX. I mean, it's a pretty decent move from where we're at right now, right? I'd say $35 range is definitely an OPEX, if nothing else. Which broker margin accounts do you like most for selling CSP and buying SPX straddles? Tasty Trade, Schwab. Um, Tasty Works. Does Tasty Trade have a brokerage? Or am I going on backwards again? Tasty Works. Oh, okay. Yeah. Tasty Works is cool because they give you just like degenerate leverage. And you don't need a lot of money to get like really high level options strategies unlocked. Schwab's obviously more stable. I use IBKR for most of my SPX stuff though. The data is cheaper and better, so Schwab's not as degenerate with the margin. IBKR is not very degen with the margin at all. They're a little strict with their margin, but I have portfolio margin on IBKR, so I have no idea. I just thought it was Tasty Works. I thought Tasty Trade was like a YouTube or something. Maybe it is the same company. Maybe that's why I always get so confused with it. $35 range is a $40 move pre-split. Yeah. I mean, I'm just trying to be conservative with my targets, but I mean, obviously if FOMO comes in and people are getting a little frothy about GME lately. So if we get some FOMO, we could get another big run. I don't know if it'll be as big as March, but it might be somewhere between May and March, and that would be insane, right? The skew of Gamma Max. It wasn't Gamma Max. You talking about like Gamma Dispersion and the SPX? Gamma weighted dispersion? Yeah, gamma weighted dispersion's doing some weird shit on SPX right now. The last time that happened was before 2020. It could happen within 30 days, yeah. I mean, the Fed already raised the rates, so that aspect of a crash is locked in. And you know, if you look at JPA's face during his last speech, it seemed like he knew what he was doing. Or the damage he was going to do, at least. If you sold 2750s at the peak of our run last week, you could have made slightly more than 750 a contract. That's huge in helping lower your cost basis. Yeah, it is. I mean, it's just $7 off your contract, right? I didn't really sell a lot in the money at near the peaks last week, and the halts were problematic. But that's the great thing about Opex in selling cover calls is with ETF FTDs and these like liquidity grabs, you don't generally have a lot of time to sell covered calls. With Opex, you have a ton of time to sell covered calls, right? So you don't have that time pressure. But yeah, on the run earlier this week, I managed to get out some like 40s and 35s. I haven't redone my GME cost basis in a few weeks, but I think I've got to be getting close to like $4 ish a share. So if we get a big OPEX, my cost basis on GME will move negative. But that, yeah, it's a huge, like if we move to like $50, you know, that's like $25 of value that can just be captured on GME, with fairly low risk of assignment if you're selling far enough out. And that's a huge amount that you can shave off your cost basis. And obviously you could take less risk with that, right? You could go like $10 in the money, but a $10 drop on the entirety of your cost basis on GME is huge for most people, right? That could be the difference between having a cost basis of 30 and 20 or 40 and 30, right? And that's you know, if people really want to get their cost basis down, that's the way to do it. And that means that, you know, going into the future when you're selling covered calls, you're also taking on, you know, less risk, or you can take on more risk because you don't have to worry as much about assignment. Best brokerage for future scalping, probably Ninja Trader, or IBKR. If you don't care about assignment, would it make sense to sell 3250cc and buy a 35C for net credit for OPEX since they're next month? If we get OPEX, sell calls on the peak, buy back CC after drop. So you're buying the 35 up front, so like a debit, and then you're spreading it with the credit. I mean, that's kind of what I do anyway. Like I generally don't close out my long calls for OPEX until I start selling covered calls. Right? That way I'm hedged if it keeps moving up. Yeah, $10 is fucking massive. How far out have you sold those deep in the money CCs on large runs in the past? The only time I've really gotten a good opportunity to do it was in March and May, and I sold them both. March I sold 45 DTE, in May I sold 30. I wasn't super deep in the money, but I was pretty deep. I mean, like 0.6 delta, 0.7 in March. Pezza, welcome to Dillionaire, man. Thank you so much. Message me on the Discord. I'll get you added to the country club after the stream, man. What's your short midterm forecast for Fubo? Probably pretty boring till OPEX. It is still an OPEX stock and still a volatility short. So expect it to stay within the timeline of everything else in the basket. Hopefully earnings put a little pressure on them. Earnings was good. It's going to attract more institutional investors. That's what they're trying to do by dropping the gambling side of things, is bring on institutional interest. Probably because in the future, they're going to want to dole out that $750 million shelf offer. And they probably, given that they've been buying equities themselves as insiders, or buying shares themselves as insiders, do not want to do it in the form of a stock dilution, or share dilution. So they're going to want, probably to issue bonds and stuff. And the best way to find buyers for those is going to be attracting institutional investors. So they're doing the right things. Fubo may not be the best company in the world, but they're pretty well run, I think. And I think they're pushing through their growth cycle in a very intelligent way, especially given the economic uncertainty right now. Like I said, it's a long-term play. I don't particularly care about near-term price improvement. If it happens, I have some positioning to capture it, but if it doesn't, I'm mostly in shares and very far-dated leaps. Net credit up front, sell the call at peak, then buy back CC after they tank us after Opex. Oh, but your credit up front is terrible, right? Like your credit up front's so much worse than if you were selling at the top. You're just going to be super underwater at the top, right? Also, your chances of assignment during an OPEX run are way higher than, yeah, I'm not a huge fan of those. Why not like synthetic longs if you want to do that? That way you can, sell the call at the top, buy back the CSP at the top. You have two positive positions instead of a fucking super underwater covered call and a call. When you say sell aggressive CCs with a lot of theta, because extra theta lowers the chance of getting assigned. How much theta are you talking about here? 30 days, more or less, like 30 to 45. Is Opex in 2 weeks gonna run Fubo and Upstart too? We'll see. I mean, they're all primed. They're all kind of illiquid. They've all been shorted very, very heavily over the last quarter. Not only the stocks themselves with Upstart and Fubo, but the volatility with all three. So they look like good picks for Opex. Fubo stands out to me because it spent a very decent chunk of this quarter on Reg Show, which forces synthetic liquidity. So whereas GME and Fubo liquidity can be found or derived from other sources besides synthetically, GME a little harder, obviously. Fubo much easier. Upstart probably has the most synthetic short positions created on it out of the three because of its reg show inclusion. Do you use weekly RSI much? No. RSI is kind of pointless. You're not gonna get a lot of out of RSI that you can't just get from looking at the price. It's nice to see relative levels, but we're in a bear market, so they're kind of meaningless anyway. Thank you, Trina. Did you just discover the emojis? There's a bunch of them. I have like a obscene number that I'm still supposed to upload, but I haven't gotten around to for the last 9 months. What if Upstart doesn't run for Opex? I close out of my position and wait till it goes back on reg show. That's the risk you take playing Opexes. There's nothing in the market that's without risk, Bruce. There's no way to make money without taking risk. And obviously, over-shorted stocks that are very high volatility going into, frothy market conditions on an economic decline are some of the riskiest, but the reward potential is extremely high. If you've never had calls that printed during an actual OPEX run, you haven't lived. Feels like IBKR is well rounded, especially its ability to trade SPX and VIX basically 20 hours a day is a huge advantage. What do you think it compares to on Schwab on financial reliability? I'd say they're, I mean, Charles Schwab is probably one of the most liquid brokers, if not the most liquid broker. I think they have like 14 trillion in assets under management. Lower now because of the bear market, but you know, nearer the beginning of the year, 13 or 14 trillion. They have a lot of money. IBKR is smaller, 1.5, 1.6 trillion, something like that. So liquidity wise, Schwab is safer, but IBKR is a lot more useful. That's a bearish diagonal spread on Bobby. Just hard not to want to sell some sort of short dated CSPs with the high IV. I mean, my problem with selling CSPs on Bobby is I don't want to own it. There's a lot of other stocks with high IV. Why Bobby? You see Fubo retaining current price levels if a crash happens. I mean, it's pretty index exposed. I'm sure the price would drop pretty hard, but that could also, you know, when prices drop really hard, that incentivizes buyers, right? So, yeah, it could fall to new lows even in a crash. It's a crash, right? But how long it'll stay there is the bigger question. Rasolio, welcome to Dillionaire, man. Thank you so much. But why hold out? Why hold longer out Upstart calls for Opex if everything is focused on Opex? Because it was on Reg Show, so it already positioned into them, which I told people like 100 times. So while it was on Reg Show, it could run at any point, right? And so the risk of missing the run was worth holding the positions. Not to mention, all of my Upstart positions are discounted like 80 to 100%, right? Because I've been buying them with CSPs. So it doesn't cost anything for me really to have the exposure on the long side. They're dated for January, so I don't care about their theta decay and the rate of Vega acceleration on a potential run will more than make up for any like near term drop in price due to a decline in IV or delta, right? So free calls that are far enough dated that I don't really care about their price. I wasn't gonna get rid of the position because it fell off of Reg Show for 2 weeks, right, and then buy back in. I'll just, especially with earnings on the table, I'll just hold on to the position. I already have most of it at relatively low IV. The only difference is the delta's dropped. So I think that's the problem is a lot of people aren't entering Upstart the right way using CSPs. The advantage to Upstart was that you could get free exposure, relatively, well, close to free, long side exposure with near dated CSPs, and get, you know, significantly more theta on the call side. Still that's true. I mean, puts on Upstart are still very, very expensive. It's not really free exposure when you get assigned on all your CSPs now, is it? I've only been assigned twice. Um, but the shares still have value. Like I'm not really out a lot of money on the assignment, right? I mean, I sold $20 CSPs for like $1.50. The price is still above or close to $19.50, and my buy-in price on those is $18.50, right? So I'm up on the shares that I got assigned on. Wouldn't that be higher risk if no packs and the price drops? Yeah, absolutely, because you have leverage downside. But I mean, it's pretty shitty if what if you get assigned on your CCs, right? And you've sold 35 dollar covered calls and they're getting assigned, 2,000% up, then you've got, not only the tax liability, but, your offset on your potential gains because your calls are another $2.50 out of the money. But you could sell your calls, buy closer dated ones that would be way more profitable for Opex. I could just buy more calls for Opex, and they're not way more profitable. You're forgetting about the effect of Theta and Vega. The rate which Vega increases on farther dated contracts is significantly faster than on shorter dated contracts. So on a significant run, 20, 30, 50%, those farther dated calls are going to be far, far more valuable than a nearer dated call. Because then you start to get a multiplier on your implied volatility, right? Because extrinsic value potential ramps up. What happens if a 0DT SPX isn't sold while in the money, is held to market close, it's exercised for cash? They're all cash settled, so you get the difference between spot and strike times 100. Jim wheeling GME since before the squeeze, but found improved gains with your analysis on timing and different price target strategies. Thanks for sharing your analysis and discussing various plays. Thanks, McHambler, Hamburglar Helper. I appreciate it, man. All right. Well, I guess that's about it for today. I'm all caught up. Pickles Picks will be out tonight. Probably later. I want to watch futures for a little bit, but outside of CPI this week, I don't think there's too much to talk about in regards to the market. Things are very much in the same position they were last week. Where will IV go if Upstart runs for Opex? It could go pretty high. I mean, they have kind of a small float, 66 million shares. It really depends on how much volume it gets, but I mean, intraday IV could hit 200. I think closing IV, which is usually lower, I think the peak this year was like 160 or 180. I'll let you talk more about the coming crash you're expecting. I mean, I feel like I've covered everything about that. Now we're just waiting to see if we get the melt up in SPX that we think we'll see, or if we just crash, because that's a possibility. It's hard to manage and it's hard to play both sides of it, because if we do get a melt up, the crash will be extremely rapid. So you need to be positioned on like both sides of it simultaneously. It's kind of difficult. So I'm DCAing into like long dated short positions, but also uh, trying to leverage near term long positions in order to capture any potential upside. And I'm going to continue to do that throughout this week and probably the following weeks until something breaks. Can you please look at DDS? Sold CC? Really? You got a fill on a cover call on DDS? It's fucking impressive. Sold CC in the money for December 16. Wondering if I should buy back for profit, sell again on a spike. I don't mind getting assigned at all. Oh, let me bring these out. Hold on. This is not in the right fucking spot. There it is. I think it'll drop further. before Opex. So you probably get another entry opportunity somewhere in the, like, or a buyback opportunity somewhere below, 304. Maybe like 289, 280 in that range. So I think you could get a lot more profits out of it if you're in the money. Yeah, I think Opex still looks really good. $300 and $320. Oh, okay. Yeah, so yeah, we might. I would say DDS could see a drop. I mean, potentially even as low as 270 over the next 2 weeks. Although it's a lot more liquid than GME, so their ability to short it is kind of limited. I wouldn't target the 270 range, or 280 is definitely possible over the next, like 2 weeks. 280 to 283. Yeah, no problem, man. Just might be a better opportunity if you're a little more patient. I don't think it'll run super hard before Opex, but it might pop a little bit tomorrow with the ETF FTDs. All right, guys, thank you so much. So yeah, Pickles picks out tonight, and I will see you all bright and early tomorrow morning at somewhere around market open. Thank you guys. Enjoy the rest of your weekend and have a good one.